For joining, everyone dialing in today virtually. My name is Shireen and I work for the DIFC FinTech Hive, and I'd like to kick off this week's webinar Wednesdays by giving a quick hello. Let me start off with an introduction of DIFC FinTech Hive. For those of you who may be dialing in and not know us, we are the FinTech hub of the DIFC Authority. We effectively run accelerators, co-working spaces, and a community, basically what a FinTech really needs in order to grow. That being said, we've also taken upon ourselves to educate people about FinTech, who are the founders, who are the corporates driving FinTech. And Webinar Wednesdays is an initiative that we've started running really since COVID in order to spread the word, make the information available digitally. Previously, we used to make people come to the office, and though you can still technically come, we're not open for events yet. So thank you very much for tuning in. The session this week is all about wealth tech, and more importantly, how individuals can create wealth using technology. And we have a fantastic and diverse panel of experts. I'll be asking each of them to introduce themselves individually. And we'll start off with Wael Salem, who is the CEO of Tradesocio. Tradesocio is a wealth management software for advisors. And Wael's ambition is to really drive the future of investment management. So Wael, if you don't mind, I'll ask you to tell the audience a little bit about you, what you do at Tradesocio, as well as really your experience in wealth management in the region and internationally too.
All right, thanks a lot, Shireen. My name is Wael Salem. I'm the CEO at Tradesocio. We are a Singapore-based fintech development company focusing on wealth and investment management services. I am Egyptian, born and raised in Dubai, graduated from American University in Dubai. Had my first, even though graduated as a developer, had my first post in DIFC 13 years ago. And since then, I've worked for 13 years in capital management, brokerage, fund management, and advisory. And recently, I've moved back again into technology, where we are building technology solutions and building investor experiences for brokerage and capital management and financial institutions.
Thank you very much for the introduction, Wael. Next up, proud to say is a woman, Tanya Rawat, works at Daman Investments. Daman Investments is a leading regional investment company. And Tanya's role there is a portfolio manager, and she's actually quite experienced in cross-market strategies. Tanya, would you mind giving the audience very similar type of an intro, who you are, what you do at Daman Investments, and a bit about your background?
Thank you, Shireen, and thank you, FinTech Hive, for having me in this esteemed panel. I think you've given me a great introduction. I'll try to, shower myself with praises. I've been in the investment management industry close to 10 years now. I've been with various data providers, right from ICE Data Services to Reuters and lately with Bloomberg. I've been involved in Arcam Capital's artificial investment drive, wherein effectively we were trying to combine asset allocation within the investment process. And as you mentioned, my most recent adventure has been with the Daman Investments, whereby I'm involved in global investment allocations across asset classes.
Tanya, thank you for that introduction. And last but not least, Amir Tlapsh, who works at Emirates Investment Bank, has joined us for today's webinar. Emirates Investment Bank is an independent boutique investment financial firm. And Amir over there leads the global markets, it's a bit of a mouthful, multi-asset class trading desk and all brokerage relationships. So Amir, in a very similar fashion, please tell the audience who you are, your experiences, and so on.
Thank you, Shireen, and really tough acts to follow. Thank you for introducing me after Wael and after Tanya. I landed in the investment and wealth tech world by luck, and happily so. After earning my undergraduate degree, I went to work as an intern in the auto loans division of a bank back home. And it wasn't long before I had to actually deliver something to the private bank and my eye caught a glimpse of the Reuters terminal at the time. I was fascinated and immediately captivated by this world, the world of charts and graphs and everything else. And I began making connections in the bank. And when the opportunity arose, I actually took on a pit trader job representing the bank on the floor of the exchange. Now, financial markets and fintechs have been my passions ever since. And 16 years later, I'm still here. I still love what I do. I'm currently the head of multi-asset class trading and brokerage at Emirates Investment Bank. And before that, I ran trading and investment advisory at National Bank of Abu Dhabi. Now, my involvement in WealthTech transpires particularly through my work running an algorithmic trading desk, but also through my association with advisory boards of various fintech companies specializing in WealthTech, RegTech, EdTech products for capital markets, brokerages, and asset management.
Fantastic, Amir. Thank you for that introduction. I'm very pleased to have such a strong panel, and I want everyone in the audience to know the format of today. So though you're all on mute, the idea is to discuss a few things, as you can see on the screen, amongst the panelists first. We'll take about half an hour to do that, and then we'll open the floor up to receive Q&A from the audience. So for those of you who are currently dialed in, you can partake in a few ways. So firstly, feel free to chat amongst each other using the chat box. But when it comes time for Q&A, feel free to send your questions in by either clicking the box that says Q&A in the toolbox, or choosing the option to raise your hand and verbally ask us what your question is. Of course, if you want to address it to either of the speakers, you're more than welcome to do that, or you can have the panel as a whole address your question. Now, the questions obviously have to be related to the topic of events. So though we're discussing wealth tech as a subsect of fintech, we're actually first going to kick things off by talking about fintech in general, in addition to fintech trends in the Middle East. And then we're going to dig a little deeper into what makes fintech in the region successful, particularly how to go about defining success through these digital products. Then we're going to talk a little bit about wealth tech and what that means for the regions and the region, as well as the various players here in the ecosystem. And then the rules of investing and utilizing wealth tech technology. And last but not least, picking on a specific type of technology that is most commonly used these days in wealth tech, which is machine learning and artificial intelligence. All right, so panelists, I have a few questions prepared in order to start the conversation. I apologize. I think I'm having some technical difficulties. All right, hopefully everyone can still see and hear me. I apologize, but this is the world we live in with virtual. It seems I'm dialed in, but I can't hear or see the panelists anymore. So why don't I start off by Wael actually asking the first question of you. Perhaps you can tell the audience, is the region embracing digitization? To what degree? What are your thoughts there?
Okay, so let's break this down a little bit. So is the region embracing digitization? Yes, we are in the scope, or we are in the process of embracing digitization. Now, when we look at, I'll be a little bit specific on the fintech and more focused on the wealth tech as the subject here. So wealth tech, as it came to the scene, as of my experience, the experience was relative more in the US and UK markets back in 2000 from the US, from the UK to EU and APAC, in which the concentration of wealth tech products and the inclusion of investors all the way to not only fintechs, but to banks and major financial institutions embracing that wave of digitization was in a complete scope and a complete effect. And therefore, as an underlying user and a beneficiary of this service, the objective was set to complete and was set as a success. Now, we are currently within the wave of embracement of digital solutions here in the MENA region. And it starts by creating the platform and the ecosystem. So the platform and the ecosystem, which from my perspective, I believe that it is maturing and it is near to maturity right now. For example, what we have, and actually the start of this was based in Dubai and in the DIFC, and it quickly started spreading across the MENA region, and now we're seeing the same effect that is going in Africa as well. So from a digitalization process, I think that yes, the region is embracing, there is the platform, there is the ecosystem that is available. Regulations are taking into the scope of offering a digital product and running the full investor cycle and the full stakeholders running the full system digitally, which is an extremely interesting perspective that we are coming into fruition right now. Now, whether the embracement, now falling back to the service providers, the first wave of embracement was done by fintechs, where fintechs are more agile, more nimble, they're easier to go to market. Where what I see right now, the next wave would be was the embracement by actual financial institutions in the UAE and in the Middle East, and that is something that we are in the process of. So as a stakeholder of a fintech, yes, I have a digital solution that is able to guide me into wealth or into investment management. But as a stakeholder or a customer of a bank, there is still maturity and there is still way to go in order to get syndicated debt services to be able to manage my wealth, be able to manage my funds and my investments through my bank provider or my customer account holder.
Fantastic. Amir, maybe I can steer the conversation to you next. How do you think the region and its institutions can take advantage of WealthTech specifically?
Certainly, Shireen, thank you. There is so much potential for the WealthTech industry in the region. The region accounts for a major proportion of the world's high net worth and ultra high net worth individuals. The Boston Consulting Group estimated that the number of high net worth individuals and ultra high net worth individuals will double by 2022. Their personal wealth is also expected to increase exponentially. Now, the median age of the region is below 30 years old, and they are very internet and technology aware. They demand even quick access to information and innovative smartphone solutions. And they are more likely to embrace these kind of WealthTech services. So Robo Advisors, for example, are one of these WealthTech services that can meet the needs of this population. And as AI gets more sophisticated, Robo Advisors will not only complement human asset managers, they will be able to compete on investment solutions and plans. Now, today's advisories cater to specific investor niche, including women, Islamic finance, emerging markets, different asset types, and socially responsible financing. Take example of Tradesocio, Wael's company. They're a top industry player in the WealthTech market. They offer B2B robo advisory services as an investment solutions based on clients' risk profile investment goals. This can particularly be beneficial to institutions and high net worth individuals by offering them more options to invest. Another example is Wahed Invest. They're a WealthTech startup targeting the niche of Islamic finance. Their online platform is aimed at investors with a Sharia compliant focus. The company not too long ago received a permit from the CMA in Saudi to launch the first robo advisory platform in Saudi Arabia. Global robo advisory players, because this is something that the region can look into, what Wealthfront were doing. They transitioned from passive investing strategies to actually active fund management. And even during these times during COVID, they stated that they have actually experienced growth while managing around $20 billion in total assets. This sounds like an alternative investing model for the Middle East to look at. Besides robo advisors, I think there are multiple other technological investment options. Micro investment would be one of them. Platforms like Acorns and Stash, They allow users to invest small amounts of money on a regular basis without paying commission. This is particularly attractive for the young demographic of the region. Students wanting to save for higher education and people who want to dip their toes in the wealth space. These platforms usually are free as applications, and they charge minimal monthly subscription fees. Challenger banks is something really interesting for the region. Now, since 2014, challenger banks have pushed global wealth tech funding to almost $17 billion in 2019. Much of the growth we've seen in the wealth tech sector can be attributed to challenger banks. Now, the UAE accounts for the most fintech startups in MENA, and it hosts the largest number of challenger banks. Now, this is likely driven by the country's vision of going cashless and the efforts people like ourselves are doing at the DIFC FinTech Hive. There are still only 4 major challenger banks in the region compared to over 60 active fintech startups as of 2019. But there's a lot of growth potential for challenger banks. And this target or this market is suitable for millennials, institutional investors, and even retail investors. Less regulations, lower fees, and so on. So I think the potential for Robo Advisors, micro investment opportunities, and challenger banks to democratize and make money management easier will appeal to the younger millennials and to high net worth and retail individuals. This will actually help change the image of wealth management as an expensive and closed shop. And as most countries in the GCC have high GDP growth, institutions can definitely use that economic evidence to benefit from the advantages of wealth tech.
Amir, I'm curious, and maybe this next question can go for both Tanya and Wael as well. Have either of you invested through one of these robo-advisory platforms, whether they're here in the region or abroad?
Touché. Are you eating your own cooking, guys?
Exactly. Do you put your
Are
money
you
where
eating
your
your own
mouth
cooking?
So I'd love to hear from the panelists. Do you?
Yes. Before starting into the development of any solution, you have to be a customer and an end user first. So I have invested back in 2016, 2017 in multiple robo advisors to get a full understanding from a customer perspective. It was more of an exercise. It was a minor allocation, but I have worked with some of the robo advisors in the UK, Acorns in the US, in Singapore, a couple of them as well. So it was a part of a research, and it covers my investment mandate. So yes, I have invested with robo advisors and in robo advisors before. Good
to hear. Tanya, what about yourself?
It's interesting. I mean, I like the way Amr just sort of, the way he narrated the whole growth of the industry and where we are today. Myself, I graduated from Manchester Business School in 2008. I got my first job in very tough times in 2009. And that's a year later is when you had the advent of Wealthfront and Betterment. These are robo-advisors which have been around for a decade now. And that was interesting for me because the minimum investment was $100. And for me, in my first paycheck, a paycheck, I said, all right, let me try investing and seeing if this makes sense for me. And that for me was a very interesting learning curve to see how the applications of artificial intelligence and machine learning, as simple as asset allocation, is automated. It saves money for me as an investor, as a student investor, and just fresh, or a graduate, as you can say, it's just fresh out of college. No bank is going to give me, give me an investment advisor because you need a minimum bank account. So what it did for me back then, when I think of it now, a decade later, is help to democratize the process. It made it easier for a lot of people, a lot of students, a lot of graduates to start investing very early on, which is something you do encourage. But what you do end up doing is piggybacking on your mom's account or your dad's account or your brother's or your sister's account who already have X number of years, they're professionals. But as a young graduate, I think this is something I profess this a lot, that you should start saving as soon as you get your first pocket money when you're 15, 16. But then again, the kids ask you, oh, what do you do with it? Where do you invest it? Now we have a solution. That's robo advisory.
Fantastic. I myself, if you don't mind me chiming my experience as well, I invested through Sarwa, which is a robo advisor, homegrown in Dubai out of the Hive. More actually so because I was curious about how the technology worked. I especially was curious about the fact that I could go through the entire onboarding process, through the advisory process, make the investment without interacting with a human. And there is effectively technology behind it, machine learning, artificial intelligence. Perhaps, Tanya, if I could keep you going, ask you the next question. Given that
And
you
I
have...
have a question for Tanya as well. So
Who wants to go
because,
first?
I'll go first.
Go for it.
Oh yeah. Because I'm really curious about it, because I've never heard that asset manager. Usually asset managers are very defensive when it comes to talking about robo advisories. And I was actually, when I was framing the answer in my mind, I remember Tanya's here. So I did say that robo advisors with the advancement of artificial intelligence complement currently and eventually will be able to match. But I think that systems, technology can outperform a human, and because I work in algorithms a lot and all day. So I'm curious to know, Tanya, because I've spoken to a lot of asset managers, they're saying, no, these they'll never replace us. It's not about replacing, we understand that, but I'm interested in your perspective.
I think, to answer both Amir and Shireen, your question, and I think that's the question everyone has in mind is, there's one line for me to answer it, and then I will elaborate, and that is antipathy to artificial intelligence leads to apathy of adoption. If we simplify it, that basically means, okay, let's take a step back, before we delve into these topics. What is artificial intelligence? What is machine learning? These are all fancy words, but these are words which have been around for close to 30, 40 years now. Because simply put, artificial intelligence is a subject. So think of economics, think of mathematics. Artificial intelligence, the word itself says artificial intelligence. It's us trying to study or ways to build machine or systems or methodology which can replicate human intelligence. Machine learning is a subset of that. So machine learning is basically simply statistics, how you can use statistics to simplify mundane, iterative, repetitive tasks. So that's essentially what that is. Now, coming to the point of how does, is automation completely going to take over, and, are human advisors, not going to be relevant anymore? And I think for me, I use it. I'm one of the top 2% women in the world who use algorithmic market neutral trading strategies. So I know, because I use this completely in my process to save time and to search for ideas. So the way I do this is I use algorithms, and these are built by me. So humans build machines. Machines don't function on their own. So we have to work together. So the first step is I decide and I tell my machine, okay, search for X things and give me the output Y. They do these things, they take some time. It could take me, I could hire an analyst for 2 or 3 times the cost of a machine, and they could take 2 or 3 times longer. What this machine does is it does the repetitive tasks which I ask for it and takes less time. So it saves me costs, saves me time, and most importantly, it's efficient. It streamlines the process, which is repetitive. Once it does that, it gives me a list of solutions. Now, these solutions as an advisor is up to me. Either I can remove myself from the process, and these solutions are given directly to the client, which is fine. But what happens when you have a situation like COVID? Does a machine speak to a client and say, oh, it's going to be all right, your savings are going to be safe? Yes, we have a 20% correction in the market. It's a 15% correction. Microsoft is going to come back. Your cloud stocks are going to come back. Airlines are going to pick up travel. So these things, the psychological aspect, the final aspect of managing expectations, telling people that their savings are going to be safe. So this aspect always will require a human advisor. I completely agree in terms of automating a lot of the tasks which save time and money. But in the end, I think a marriage of automation and human interaction is the right way forward, and which is something we have seen. If I can jog my memory, it's DFA or dimensional Financial Advisors. This is a company which is started by two students who studied under Eugene Fama. And Eugene Fama, we all know, is well known for his theory on small cap, large cap stocks, and how you can use fundamental analytics to actually pick stocks. So these students decided to build machines, but at the end, they have an army of advisors who basically pitch these systematic allocation algorithms to clients. So it's a beautiful marriage. So I think that's a case in point, and it's a good case study for anyone who's looking to understand how this marriage can work.
I agree, Tanya. They do go hand in hand quite a lot. And with the same company I mentioned to you earlier, they did offer all the customers who are being onboarded the option to speak with a wealth advisor should they need further clarification or rebalancing of their portfolios and whatnot. Well, let's perhaps bring you back into the conversation. I'd like to ask, how does a tech company, WealthTech or otherwise, actually go about ensuring success in whatever part of the process they choose to take digital?
So I'll discuss digitization as a definition of what digitization is. So there is a concept in which that whenever we speak about robo, everybody, especially fund managers or advisors, they would always come and discuss whether we are needed or not. And that falls under a discussion which is actually 1% of what robo is. Robo and any financial service or any customer service will always still have a human purpose and a human interaction with us. Now, the scope of robo advisory is that you are expected to step back away from the picture from what an advisor or a fund manager is and look at the whole process from A to Z. And the whole process, which takes into itself the customer engagement and acquisition, onboarding, all the way to there is the onboarding, compliance, then the proposition, facting, and moving also into back-end applications in which it's execution, risk management, and reporting. This is what robo-advisory is. Robo-advisory is not creating an algorithm in order to replace a fund manager. Actually, the fund manager and the advisor could be taken into account that they are the only profitable person in this full cycle. So why replace them? Replace them because everything else is a major cost. So when you look at a digital product, the major impact over here is, I would summarize them in three things. One is the cost of acquisition, the cost of retention, and the lifetime value of the customer. Now, when you look at the fundamentally basic wealth solutions that are offered from your bank and my bank and so on, which is basically investment plans and lifetime and life planning over mutual funds. This is the most basic investment product that is available to any person that holds a bank account. Now, the solutions that are offered and the advisors that are offered, 99% of the scenario are given to clients that are either high net worth, ultra high net worth. You must own or have $1 million in assets in order for you to qualify to these solutions. And in the most average banks globally, this is less than 1% of the customer base of the bank. Now, the question is, why bring robo-advisor, and what is the impact of robo-advisor in that financial institution? The impact of robo-advisor is these 3 points: lowering the cost of acquisition, increasing the lifetime value, and lowering the cost of retention. And when doing so, you are able to scale the same product with the same headcount and the same team to either mass market, which will cover another 25% by average of a bank customer base, or a retail market that is 99%. So bringing in a robo-advisor usually, and in most of the average cases, into a financial institution will increase headcount, will increase and actually increase headcount, increase scale, increase expenses. But lowering these cost factors allows you to mass market that product that was a unique niche product to only ultra high net worth and ultra high net worth and $1 million account holders, all the way to your retail market providers, to your retail customers. So now bringing a robo-advisor in allows allows, in the case of a new student, fresh graduate, to be able to invest and build up and accumulate wealth and be financially included into a wealth tech ecosystem. Exactly the same, and he would be a beneficiary of the same product and services that are available to the ultra high net worth customer in that bank. And a definition from a technology perspective, this is the robo in advisory. The robo in advisory was never to replace the alpha generation in the whole formula, which is fund managers or the asset managers or the allocators or the distributors. But it is a process in order to allow scalability taking into account effective spending. And effective spending and the investment in the technology allows to touch on every stakeholder that is available. So instead of a process to onboard an ultra high net worth and fact finding and signing all the documentation, going through risk management, compliance, manual execution, manual reporting, timely reporting from a month to month, we can right now deliver the complete service cycle in a few minutes, execution in a few microseconds, reporting in real time. And by doing so through a digital platform, we are able to automate the complete business process management from end to end, providing a full reporting architecture that allows all stakeholders to stay informed and to be able to audit the process. But at the same time, we are reducing all of these costs, allowing the product to be scaled to all the users within a bank. And this is our scope, and this is the way that we look into how to be able to successfully launch a digital product from our perspective as a technology.
Shirin, if I can add to that, I mean, I just want to take the thread from what, where Wael left it off. 2 points. One thing he mentioned is, and he's absolutely right, the fiduciary duty of an asset manager or a fund manager or a wealth advisor at the end of the day is to generate alpha for their, for the clients. That's it. That's the end goal. Now, if you look at it maybe a decade or 2 decades ago, we didn't have as much data as we have today. We are constantly, barraged. We have an avalanche of data coming in day in and day out, whether it's from social media, whether it's from, any kind of media outlet, whether it's TVs or, curated news content and so on and so forth. So in terms of vast amount of data and limited resource, we all have the same limited resource, and that's time. We all have 24 hours in a day. How do you make use and the most efficient use of the 24 hours in the most cost-effective way? Let's say I want to see, for example, there's a discount store in the United States. It's known as Target. Now I want to see how has Target managed to grow year on year, and it's a brick and mortar store. They don't have any online shopping, but they're growing year on year, and they target low to middle income groups. How is it managing to grow in the face of a behemoth like Amazon? So when I'm trying to track these things and understand these trends, what do? I probably tap into satellite imagery and try to see, okay, the parking lot, how many cars are there year on year? Are they seeing an increase? And what am I trying to do by this? As simple as trying to track footfall. It's just one example, but this is so much data. Now, if I was to do everything manually, tapping into a system, doing this and doing that, rather, if I organize it into my algorithm saying, okay, look at, for example, social media for keywords, footfall. I look at satellite imagery, look at increase in number of cars. All of this is programmed, and this leaves me more time, say, for example, to look at new themes, new ideas. And I think that's what Tradesocio, one of the things they offer is thematic baskets. And these are new themes, new up and coming trends that I can look at. These are new idea generation. These are things which I can focus on. So one side is automated, it saves me time. And on the same side, concurrently, I'm looking at new ideas. So there you see, it's a marriage. There is no, it's almost complementary.
I'd be curious to delve more into self-directed investments through various WealthTech applications, in addition to all the automated AI, ML-driven examples we've all covered so far. Amir, perhaps we can get you back online. I'd love your thoughts. What do you think of self-directed investment offerings through apps nowadays? What's currently being offered? What's the opportunity? If you have thoughts on that.
Certainly. Well, we've seen demand for wealth management or wealth managers rising in general, especially among the millennials, whether to manage their own wealth or to learn more. This has definitely given a boost to self-directed investing. Millennials will soon make up the largest demographic group in the world, with an aggregate net worth of as high as $24 trillion in 2020. Now, the reduced trading fees, faster transaction speeds, and simplified form of investments that are offered through these kind of apps have made self-directed investing easier for everyone. And self-directed investment, by the way, is not just about convenience, it's actually about empowerment now. Having constant access to your portfolio means you can track market development, manage your financial dealings whenever, wherever you are. Mobile investing applications, they send you notifications about market updates, automatic trading signals. They're no longer just mimicking desktops or syncing functions between desktop and mobile services. They have actually become co-equals in trading. Many investors and traders prefer to work with brokers and trading platforms that offer mobile apps. If we look at the 2020 Barron's report, mobile logins accounted for more than half of the total activity, and mobile-only investors made up 25 to 30% of total customer base. TD Ameritrade reported that 27% of its total trades are done via mobile accounts, while Interactive Brokers stated that many of its most active clients trade exclusively through mobile. Now, these brokers have redesigned their platforms to offer more services to investors. AI, machine learning are now being used in customer service to analyze portfolios. So Robo Advisors are not the only players out there, or this time, Interactive Brokers, they offer something called For You notifications. They present account-based reports to clients, from announcing a dividend payment to notification that an option has expired. Voice-related services are also being explored by some platforms. E-Trade offers voice automated commands for both Apple and Android devices. And TD Ameritrade, they allow users to actually trade using Amazon's Alexa. There's a new niche on the horizon as well, which for someone like me is weird. It's called Fractional Trading, which is a practice that targets the younger audiences. And in January of 2020, Fidelity actually changed the game when they announced that they will actually allow investors to trade in dollars instead of number of shares, even if it meant buying less than one share. All of these trading platforms have become more sophisticated, more pronounced with their services to traders. And a major proportion of these self-directed investors are also looking at long-term investment propositions than just only short-term. The top platforms like Fidelity, Interactive, they meet the needs of both types of these investors, whether it's active traders or mature investors. And there's a potential for other financial institutions to tap into that market of long-term investment sector option, especially in the region. And in addition to these online brokerages, well, there's the $1 billion industry, which we've already spoken about, which is the Robo Advisors, booming under WealthTech. They're also flourishing in the UAE, Tradesocio leading the way. And these Robo Advisories can benefit any beginning investor looking to learn more about the rules of the game before actually moving into the more self-directed platforms.
You know, FinTech Hive did a research on post-COVID FinTech trends, and we dug into wealth tech and personal finance management as an area. And we absolutely saw a big spike in self-directed investment apps, but it was actually more due to consumers' speculation because of what was going on with the markets post-COVID and whatnot, as opposed to, let's say, a desire to invest and grow their wealth. For me personally, I am a bit risk averse, so I would always rely on someone else's feedback, whether they're human or machine. So perhaps, Tanya, we can loop back into the AI machine learning side of things. And if you could please tell me what you think would be the benefit of these tools to asset management and FinTech as a whole.
I think the common theme that we have been talking about for the past 30 minutes or so has been this is a natural advancement in the existing asset allocation process. It actually is embedded in the process and it complements the process. What it does is helps to maintain the quality while we are managing a large quantity of data. And that's where machine learning comes in. You tell the machine to learn from a data set. And there's a subset of machine learning, which is known as deep learning, whereby deep learning is a fascinating branch whereby it replicates what the neurons in the brain speak to each other, and something that's similar you can create in a model whereby you train the data set to learn from the trend. So you can give it a data set going back 100 years and seeing how S&P has done, for example, or how the DFM has done since inception. And then whenever there is a future event in there is a future, say 10 or 20 years ahead, if you want to make a projection, what it does, it learns from the past and it makes or builds correlation and covariance matrices up ahead, and then predicts, say, the price of, for example, IMAR is going to be X, Y, and Z, and so on. Now, in terms of coming back to your question of what are the benefits, the benefits, one of the benefits is, yes, for me as an asset manager, I can manage and do a lot more work, look at a lot more new themes. But the most important thing is for the entire ecosystem, it offers one big advantage, and that's increasing liquidity. For example, you mentioned an increase in the growth of investing via these apps, and one name probably would have stood out like a big bubble if you've done the bubble diagrams is probably Robinhood, and that's primarily because anyone with a $100 probably can open an account. So what this did for the market is it increased liquidity in the market. So if we have the likes of Tradesocio, Wahed Invest, Sarwa, and X number of players come in the region and they increase exposure and direct their focus, say, to our markets, what happens is you increase liquidity. What happens when you increase liquidity? It's beneficial for everyone, because for me as a consumer, it makes it cheaper for me to buy a stock. For now, it's very expensive to buy a stock in the region because you have less players in the market. So it increases liquidity, more players, it makes it cheaper. When it's more liquid, it's cheap. What happens is more companies will want to come to the region to list, as opposed to going to London, as opposed to going to Amsterdam or Hong Kong or Singapore or the US to list. They will want to list. You will have more IPOs come to the region. And what is a subset of that? You'll have more startups. So it's a complete circle. So when I talk about advantages, it's from micro to macro.
Very interesting. On that, as a closing note, just because I do want to leave room for Q&A from the audience for the panelists. At the Hive, we definitely see one of the top areas of interest coming from founders and innovators looking to innovate in the fintech space is actually wealth tech. And we see an abundance of wealth tech companies come with both B2C offerings, so meaning they want to offer their solution to consumers directly, or a B2B offering, meaning that they would want to partner with banks in the way they offer retail banking and wealth management. With that, panelists, thank you very much for your time. I do want you to stick around so that we can address any questions the audience may have. But since I'm facing technical difficulties, I'd like to introduce my colleague Fatma, who's always behind the scenes in FinTech Hive, wonderfully managing all Webinar Wednesdays. Fatma, would you mind please coming on, saying hello to the audience and reading any questions that may come through Q&A? And also, just as a reminder to everyone, I believe the raise hand option should be available.
Thank you, Shireen, and thank you also to all the panelists for the interesting insights. I think that leaves us with around 15 minutes for Q&A, and we had a couple of questions come in as you guys were speaking. The first question, so basically I'm just going to address the question to everyone, and whoever feels like they can answer it, go ahead and speak up. The first question is from Jason, and he asks, how important is Sharia investing for the Middle East versus non-Sharia?
I can take that question. I think in terms of making a differentiation between Sharia and non-Sharia investing, that wouldn't be the right way to look at it. The right way to look at it would be, as you look at any investment, what is the upside and what is the downside risk? If you look at specifically the Sharia space, we have seen exponential growth. In fact, there was an article out yesterday from Bloomberg citing a 40% increase in Islamic bonds, also known as sukuk. And sukuk is a space we actively participate in as well. the likes of, yes, the heart and home is Malaysia. That's where the Sukuk or the Sharia global, investment, global Islamic investment started off. But now you'll be surprised to hear, but maybe not so surprised, that one of the largest issuers of Sukuk, Sukuks have been Saudi Arabia, UAE, Bahrain, yes, these three in that order. So for me, if you want to make investments, look at it in terms of what are the upside potential. And for me, it compares and is currently offering much higher and safer returns. And if you're comparing it to traditional fixed income classes, it offers much less volatility. So if you're a risk averse investor, I would say if you're looking at fixed income, also make an allocation to global Sukuk as it has a lower volatility.
Just to add something there, Tanya, now, in addition to upside potential, which is definitely how you assess any type of investment, capital appreciation, risk to reward, the particular question phrased by Jason, there is an importance to Sharia investing versus non-Sharia, is that there is a barrier to entry to some people who cannot invest in products that are not Sharia compliant. So if I am of a particular belief that I can only invest in Sharia compliant products, if they do not exist, then the investment world for me does not actually exist. So having more of them, in addition, of course, to the upside potential, you're 100% correct. But we need more of these products for the people that want to invest, but just don't want to buy a regular bond, but they actually want to buy a sukuk or a structured product with underlying investment in Sharia compliant products. Hence where the technology as well, like those of Wahed, would be interesting to that particular niche of clients.
Thank you, Amir. The next question is actually from the same person, Jason, and he asks, what next generation of Robo Advisors going to do, and where is the product innovation?
I'll take this one, in which that I think that there are a few pieces of innovation that comes within Robo Advisory. And Robo Advisory, in terms of the algorithmic creation of the product, will be bundled with AI fact-finding. So take into account that we have a bank, and the bank has 10,000 customers, and I am able to actively manage the asset allocation of every client depending on their transactional history. So I'm able to, for example, I'll take the panelists as customer, I'm able to segment every client historical transaction and the full financial history, whether it is within the internal bank or any other data pools that I'm able to access. And I'll be able to customize and actively manage that customized portfolio on the basis of existing and historic entries. So in the event where you have a debt that you have to clear, you have a transaction that is coming up soon that needs to be fulfilled, and so on, as a robo-advisor, I'll be able to steer the investing direction and going into and tapping into that. Now, one of the other means that we are looking in terms of not development, but more of a product and a market placement is Sharia compliant ETFs. Now, there is a higher demand on Sharia compliant ETFs. As of today, I believe there is 3 to 5 Islamic ETFs that are listed in LSE. And on that basis, we are able to currently right now build either a completely fundamental Sharia compliant portfolio, or be able to execute as much as possible in a compromised and a full static portfolio that is geared towards Sharia compliant allocation. More into that comes as a byproduct of ETF investing. So ESG investing is a big theme that we are currently investing into and building more AI and stats in order to look into that. Fractional shares are something that is extremely beneficial also as a byproduct, and robo-advisors take a lot into that. So the ability to be able to rebalance portfolios, first of all, commission-free, which is a game changer to the business if we would talk about that 2 to 3 years ago, and the ability to be able to invest $1 million portfolio exactly the same way that you're able to rebalance $100 portfolio, in which both of them will have the same allocation statistics, and the same diversification with the ability of having fractional shares available to professional and retail customers as well. So it's more into portfolio customization, active customization, the ability to react to customer changing financial ability, and the ability to provide all of these services regardless of the customer theme and the customer requirement, all the way to the lowest level of investment ability, which could start at a $1. And that is where financial inclusion and robo advisory, I think, it brings into the space.
Thank you, Wael. Jason, I hope that answered your question. The next question is a bit of a long one. It's a two-part question. Are there any specific regulatory requirements or challenges when it comes to automated trading or robo-advisory implementation in the UAE? And the second part of that question is, are trading firms allowed to offer algorithmic trading products to retail or HNI investors wanting to use these products on their own?
So I can touch on this a little bit. So from a regulatory perspective, yes, you are able to offer algorithmic solutions or trading solution, regardless of the trading solution is. The regulatory requirement is that in order to endorse such a product and be able to endorse it to either professional or retail, you have to have the correct licensing. So for example, we were in a discussion regarding to this subject recently with the DIFC, and the DFSA requires a discretionary portfolio management license in order to be able to offer such solution, whether to professional or retail clientele. So the best thing to do is to always check with the regulator on what are the requirements, but according to the most recent update I have received, discretionary portfolio management is required for offering services such as signal provision or algorithmic trading systems to professional or retail customers.
Thanks, Wael. The next question is from Emmanuel, and he asks, can you recommend any areas of WealthTech to research as an MBA project? Or is there a WealthTech industry question that you think would be of interest to the industry if explored?
Well, there are plenty, actually. There's a couple that come to mind. I would say for the industry, RegTech in particular, regulatory technology, whether it's risk management or more on the compliance side. An area of WealthTech to research as an MBA project, any area in WealthTech, I believe is suitable for an MBA project. I would say algorithmic, low latency algorithms. I sit on the board of a company that specializes in that and low latency algorithms, and we've seen a lot of interest in the market. Nerve solutions and order execution management systems is a nice product. I know Tradesocio have them, but I also sit on the board of a company that specializes in that, which is ZachTrader. I've seen a lot of interest from candidates asking questions about it. So there's a lot of topics. WealthTech is a beautiful topic to investigate. And if Emmanuel needs anything, the guys have my contacts, and I'm more than happy to have a call with you, Emmanuel, and we can go through these, because I've had a difficulty choosing my own topics for my master's and my doctorate program. So I know what you're thinking about, but it's a beautiful topic to investigate. And anything that suits your political needs, so to speak, in terms of it, will help you. But it has to be something that you enjoy being an expert about. And Shireen is laughing.
It's because I want to add some. You read my mind. So,
Okay.
Amir, just to chime in, I actually, to whoever asked the question, I wanted to say, regardless of the topic, find a company that inspires you. Reach out to the founder on LinkedIn. Say, hey, I'm doing a master's. I'll give you free labor, basically, in terms of a research project. And trust me, these founders, the people who work at these WealthTech companies want the extra pair of hands. They'll be more than happy to give you some time, particularly because you're a student and you're doing it for education purposes. So find a company. Pardon?
Is that a message to Wael? He's with us here. The CEO
Go
of
ahead and reach out to
Tradesocio is
Wael, of
here.
course. So to whoever asked the question, reach out to fantastic founders and then pick your topic that way. I think that that would make for good primary research.
Okay, thank you. And thank you for your advice, Shireen. The next question is for Amir. Amir, how do regulators, especially DFSA, look into robo-advising and artificial intelligence? And how do they make sure that WealthTech, FinTech are protecting the customer assets and investments and suitability?
Okay, I think this is something Wael touched on briefly, but in terms of the regulation, I think Wael would have more info and the people at DIFC FinTech, but I know that there's a lot of testing that the DFSA were running. I think they were running a program of 12 months of testing, and they called the program Innovation Testing License. Wael can probably delve a lot more on that. But for the second part of the question, protecting the customer assets and investors, this happens whether you're working on Robo Advisor or elsewhere where custodians are involved and all of these things. So this is the technology part of the service. It does not change how the underlying investment is treated. Custodians help, segregation of assets from clients and proprietary money and all of those things. But I think from a regulation perspective, Wael would be more suitable to answer.
Yeah, so from a regulator perspective, now, whether we're looking at the DFSA or a specific or any other regulatory body in top financial centers. So we're talking Dubai, same thing, same process that goes in Singapore, Hong Kong, London, US. So there is an active management of underlying policies. So any company that wants to apply, they have to open up their books of policies. The DFSA would take a look and stress test all of these policies in concurrent in order to understand where are the risks that are identified in the whole business process. And therefore, the DFSA will basically, or any other regulator, will provide you a full list of requirements that every company has to meet in order to be given permission to operate. Now, after that is done, internal audits are required from the company, and we are expected to submit all our internal documents and internal audits to the DFSA. External audits are required. Bank account segregation, custody audits are always required. So the framework that the DFSA have put in place is from a customer perspective, we have the full confidence in it. The DFSA so far has been working on a very great reputation in terms of protecting customer needs and requirements. Now, from a corporate perspective, the requirements are not any different from any regulatory body, whether it's in the UK or in the US. There is a lot of processes that needs to be taken into place, and every company has to mandate and make sure that they work with all of these policies in order to ensure that they continue servicing these customers.
I'd like to chime in as well because on behalf of FinTech Hive, I do work very closely with the DFSA. Just to save the person who asked the question time, all of DFSA's policies, including things related to robo-advisory, is on their website. So you can always kind of refer to that. And Amir also mentioned the Innovation Testing License. That is the name they give to their sandbox, in which they did have a robo-advisor come be incubated and then graduate. So they do have a regime right now for robo-advisory, and you can absolutely avail that.
Okay, we have time for one more question and a very brief answer. The next question is, how does fractional investing work at the back end, and is there risk to users if trades are not placed properly?
Okay, I'll try to touch on this very quickly, although this is a topic that you can research. So fractional shares, by default, the owners of fractional shares, their shares are held custody by their institution, and they're not passed to an exchange. So for example, I am able to buy, let's say that I'm trading on Emirates Investment Bank platform, and I'm able to buy half a share of Apple, and therefore the custody or the ownership of that Apple, of that half a share is licensed and administered to me by the bank provider. Now, in terms of risk management, the way that we build these is that we build an order book of all of the clients, and we allow that there will be a floating one share only to be distributed amongst all clients. But as soon as the number of open fractional shares increase more than one share, then we pass that for risk management purposes to the exchange, in which that combination of fractional shares would be owned by the bank himself in the exchange, and the bank himself, they have an order book in order to have a full audit sheet on which investors or which users own the fractions of these shares that is already placed within the exchange. So there is a full order settlement and an order book that is tied to fractional shares, and this is one of the services that we provide our financial institutions. There are many institutions right now that clear fractional shares directly. So in our case scenario, if you are connected to, for example, Interactive Brokers and you're trading through a US exchange, yes, we are able to transmit your 0.0001 share to the exchange directly or through IB. But in the event where we're looking to offer a product over UAE securities or UAE equities, and there is no underlying provider of fractional shares, then we can make that provider to act as a market maker over a maximum of 1 fractional shares while passing all the other risk directly to the exchange.
Amazing. Thank you very much for concluding the last question. Everyone on the call, thank you very much for attending. Panelists, thank you very much for joining and for contributing your thoughts. To everyone dialing in, FinTech Hive will be putting a copy of this recording up on our YouTube. So in case you need to reference any points the panelists made or reference any of the Q&A, please reference the recording that will be up soon. Separately, if anyone has any questions, you can always email admin@fintechhive.ae, and we'd be more than happy to pass any questions you have via email to any of the panelists. Thank you all very much for your time. Panelists, thank you.
Thank you.
Thank you, Shireen. Thank you.
Thanks, Shireen.
Have a wonderful day, everyone.
Thanks.